Listen up. If you're sitting on silver gains right now and you still don't have an exit plan, you're not investing. You're gambling. And gambling feels fun until the market decides it's done letting you feel smart. So today I'm going to give you my silver exit strategy for 2026. How I'm thinking about selling, when I start trimming, what would make me stop, and what would make me buy again after I sell. And I'm going to do it in a way you can actually use, not in a way that sounds cool on camera. Because yes, silver has been on an absolute tear. And the best part is that it's not just numbers on a screen for a lot of you. Some of you didn't just make money. You made breathing room money. I've gotten messages from people who say this move helped them wipe out credit card balances, clear student loans, pay off a car, or finally step into retirement without that constant background dread. If that's you, I'm genuinely happy for you. Now let me say this before the internet tries to turn it into a team sport. If you want to sell some silver right now and lock the win, I get it. Different goals, different timelines, different stress levels. Nobody should shame you for taking profits. Profit is the point. But what I'm doing, and more importantly why I'm doing it, might help you avoid the biggest mistake people make after a big run. They confuse a good trade with a permanent identity. And if you stay with me, I'm going to show you the one metric that keeps me calm when price is screaming higher, and the one specific situation where I would rebuild a silver position after selling. A quick note right after this, and please hear it without ego. My YouTube stats show a lot of people watch these videos but still haven't subscribed. If you value this kind of breakdown, support the work. Hit subscribe and drop a quick comment. Our John AG. It helps more than you think. All right, let's rewind for a moment because context matters. Not long ago, silver was hanging around the low to mid 30s per ounce, and now we've been flirting around the 90 area. That kind of move does something dangerous. It tricks your brain into thinking the next move has to be even bigger, even faster, and straight up forever. But markets don't move in straight lines. They move in phases. They move in cycles. And the question is not, can silver go higher? The real question is, at what point is the easy money already made, and at what point does risk quietly flip against you? And here's where the mainstream noise gets people. When silver is cheap, the headlines ignore it. When silver is moving, the headlines suddenly show up with expert takes. When silver gets frothy, the same people who ignored it will start screaming two things at once. It's going to the moon! And it's a bubble. They'll get you excited and scared in the same week. That emotional whiplash is not an accident. It's how you get shaken out of your own position at the wrong time. So I built a framework that stops me from being hypnotized by dollar signs and headlines. And it's simple enough that you can write it down in one line. I don't price silver in dollars. I price silver in gold. That's the gold to silver ratio, or GSR. It's just a comparison tool that answers one brutal question. Is silver cheap or expensive compared to gold right now? Let's do it clean. If gold is $3,300 and silver is $33, then the ratio is 3,300 divided by 33, which is 100. That means it takes 100 ounces of silver to buy 1 ounce of gold. When that number is high, silver is historically cheap compared to gold. When that number is low, silver is historically expensive compared to gold. You can do it in 10 seconds on your phone. Open your calculator, type the gold price, divide by the silver price. That's it. No fancy charting, no secret indicator, just a simple relationship. Now, why not just use dollars? Because the dollar is not a stable measuring stick. It's a moving target. It's like measuring your height on an elevator that's going up and down. You can do it, but you'll confuse yourself, and you'll swear you got taller when the elevator just dropped a floor. And when people say, just adjust for inflation, I get it. That sounds smart. But here's the problem. What inflation number are you using? Official inflation? Shadow inflation? Your grocery bill inflation? Your rent inflation? Over decades, those differences explode. So for historical comparisons, I prefer something old school. Compare one monetary metal to another. When you do that, patterns show up cleanly. Over the last few decades, the GSR often lives in a normal zone, roughly somewhere in the 60 to 80 area. It moves around, sure, but that zone is the middle ground where silver doesn't look screaming cheap or screaming expensive versus gold. Then you get extremes. And extremes are where the money is made. When the ratio was way above 100, silver was cheap relative to gold. That's the kind of setup where you can be early and still be right. It's the kind of setup where the downside is limited compared to the upside. That's what I mean when I call it an asymmetric bet. But here's the part people hate hearing. As the ratio compresses, that asymmetry fades. The same trade that was unfair in your favor becomes fair, and then it becomes dangerous if you keep pretending it's still unfair. So what's my exit strategy? I scale out as the GSR drops. And yes, scale out, not sell everything on one dramatic day. In my plan, the first real start selling zone is around a GSR of 50. That's the point where silver has done enough heavy lifting relative to gold that I want to reduce exposure and lock in part of the win. And recently, the ratio dipped just under that level, so I trimmed. I sold about 25% of my paper silver position when the ratio hit that trigger. Not because I think silver collapses tomorrow, but because the market was giving me what I asked for, and discipline means you take the gift when it arrives. And here's an important nuance that most people miss. Selling a piece is not the same as abandoning the thesis. It's risk management. It's position management. It's how you stay in the game long enough to benefit from the next move instead of handing back your gains in a violent pullback. Now let me underline something. Paper silver gets sold first. Physical silver gets considered last. Paper positions are liquid, fast, easy to rebalance. Physical silver is a different animal. It's insurance. It's a hedge against systems breaking. It's the thing you don't casually dump just because the chart looks frothy. If I ever sell physical, it's after I'm fully out of paper, and even then I'd likely keep a core stack because life has a way of surprising you. Now here's where it gets interesting, and where most people mess up. A lot of you are thinking, if silver can keep going up, why sell anything? And the honest answer is, it might keep going up. It might rip to numbers that sound ridiculous today. But my sell signal isn't a dollar number. My sell signal is the relationship between silver and gold. Because silver can go to $120 or $150, and if gold is moving too, the ratio might not compress further. And if the ratio doesn't compress, that means silver isn't getting more expensive versus gold, meaning my framework doesn't force me to sell the rest. So I'm not calling a top, I'm managing a position. This is the difference between guessing and operating, and it leads to my next point, which is where people accidentally sabotage themselves. I'm not rotating into cash, I'm rotating into something else. Selling silver doesn't mean sitting in fiat and praying for a crash. That's the trap. People sell, feel smart for a week, then watch assets keep inflating, and suddenly they're on the sidelines with shrinking purchasing power and no plan. We're in an era where governments and central banks have a bias, and that bias is toward debasing currency to keep the machine moving. You can argue about the exact number, but you can't argue about the direction. So my approach is stay invested, reduce volatility, lock asymmetric gains, reallocate. That's rotation, not liquidation. And if you're thinking, okay, rotate into what? Hold that thought. I'm going to answer it, but first I want to point you to the description because I've left useful extras down there. Check the description for bonus links. There's a link to a premium WhatsApp channel, and there's also a link to join channel membership. Those are there for people who want the extra updates without hunting through the feed. And speaking of membership, we also offer members-only videos. There's a separate team working on those, with deeper research and more detail, and they're made specifically for premium members who want higher signal and less noise. Now back to the strategy, because this next part is where people either protect their gains or quietly hand them back. When I sell in increments. I don't pretend I can nail the exact top. Think about how you bought. Most smart buyers don't go all in on one price tick. They buy in batches. If price dips, they add. If it dips again, they add again. That's dollar cost averaging into a position. The same logic applies on the way out. Dollar cost average out. So that first 25% trim is just the first batch. If the ratio continues lower, meaning silver continues to get more expensive relative to gold, then I keep trimming in steps. That could mean another 15 to 25% if we move into the high 40s, and another batch if we move deeper into the 40s. And if the ratio reverses and moves higher again, then I slow down or pause, and I reassess. This is not a rigid one-way door. It's a decision tree. Now, there's a psychological trick here that I want you to understand, because it will save you from self-sabotage. If you bought silver around the 30s and it's now near 90, you don't need to sell the whole position to feel relief. You just need to sell enough to change your emotional posture. That's why trimming is powerful. When you sell a chunk and recoup a big portion of your initial cost, your remaining position starts to feel like a free roll. Not literally free, nothing is free, but psychologically it changes how you behave. You stop making desperate decisions, and desperate decisions are where profits go to die. Now, let's talk about that scary idea people keep throwing around. What if silver crashes? Could it pull back? Of course. Silver is volatile. That's the price you pay for the upside. But again, I'm not selling because I expect an imminent crash. I'm selling because the trade is matured. The easy asymmetry is mostly behind us. Volatility is rising. And historically, when the ratio compresses fast, silver can overshoot and then underperform gold in the next phase. That doesn't have to mean a dramatic collapse. It can simply mean that gold becomes the better risk-adjusted vehicle for the next leg. And if that happens, I want to already be positioned for it instead of trying to pivot during chaos. Now here's a cliffhanger that should make you sit up. The next phase could be the most frustrating outcome for silver-only holders. Silver goes up, but you still underperform the smarter rotation. In other words, you made money, but you didn't make as much as you could have because you stayed emotionally attached to one asset. That's why I keep saying, this is capital allocation, not identity. And yes, I know some people treat silver like a religion. I don't. I treat it like a tool. Now, a lot of you ask, did we have enough warning? And here's my answer. Frameworks are warnings. The reason I talk about ratios is so you don't need a perfect alert. You need a repeatable method. Because the truth is, there will always be another setup. Maybe not tomorrow, maybe not next month, but markets rotate and extremes return. Which brings me to the question everyone asks next. Would I ever buy silver again after selling? Yes, absolutely. If the ratio widens back out, if silver becomes cheap relative to gold again, I would rebuild the position. That's the deal. No emotional attachment. No, never again. No ego. If the math says the asymmetry is back, I'll take the trade again. Now, before I go further, I want to slip in a quick creative plug that a lot of you have asked me to share. If you want silver-related success stories, real lessons, there's a link in the description to another channel that focuses on that. Go subscribe over there too, and see how people turn small decisions into serious money. And since we're talking about people making real progress, let me say it again. If silver helped you fix something, debt, savings, confidence, share your win in the comments. It keeps morale high, and it gives newer viewers a reality check that these moves can matter in real life. All right, now let's get tactical, because 2026 is not going to be a gentle year. Here's the core of my plan for 2026. I'm watching the GSR like a hawk, and I'm treating 50 as a major pivot level, not a magic finish line. If we compress into the 40s, that's a different world. That's where silver is historically expensive relative to gold, and that's where I expect sentiment to get manic. And when sentiment gets manic, the market starts punishing late arrivals. The headlines get louder, the predictions get crazier, the new paradigm crowd starts screaming. That's usually when you want to be the calm person selling to the excited person. So if we go into the 40s, I'm likely trimming more. And if we go even lower, into the low 40s or high 30s, then I'm probably close to done with paper silver. But I also want you to understand something important. Even while I'm trimming silver, I'm still bullish on precious metals as a theme. Currency debasement doesn't stop just because you sold one position. Monetary stress doesn't vanish. Geopolitical risk doesn't disappear. So I'm not leaving the arena, I'm repositioning inside it. And that brings us to the obvious next question. What do you rotate into? I'm going to keep this general because everyone's situation is different. But conceptually, rotation means moving from the asset that has become relatively expensive into the asset that is still relatively cheap, or into assets that give you a better blend of upside and stability. For me, that could mean increasing gold exposure when silver has outperformed. It could mean keeping a diversified basket that includes metals, equities, and select real assets. It could mean focusing on things that benefit from the same macro environment but carry less whiplash. And this is where your personal goals come in. Are you trying to maximize returns? Or are you trying to reduce risk while keeping purchasing power? Because those are not the same mission. Now, I know some of you are already writing the comment, but gold and silver move together, so isn't this overcomplicated? And you're right about one thing. Most of the time they do move in the same general direction. But the ratio is what tells you which one is leading and which one is lagging. Here's the clean logic. Imagine gold is $3,300 and silver is $66. That ratio is 50. Now imagine both metals double. Gold goes to $6,600 and silver goes to $132. The ratio is still 50. That means you can have huge dollar gains while the ratio says nothing has changed in relative value. So when I say I'm not selling based on a dollar number, that's what I mean. The ratio is my yardstick, not a price target. That also means something else. It's possible for silver to hit a headline-grabbing number and still not be expensive versus gold, depending on what gold is doing. And it's also possible for silver to look cheap in dollars while being expensive versus gold if gold is underperforming. That's why people get confused when they only stare at the dollar chart. Now let's talk about why 50 matters in the first place. I'm not pretending 50 is a law of physics. It's just a zone where, historically, silver stops being the obvious underdog and starts acting like the star of the show. And when silver becomes the star of the show, volatility follows like a shadow. Volatility is not just price goes up and down. Volatility is what shakes people out. It's what turns strong hands into weak hands. It's what makes you sell the bottom of a pullback and buy the top of the next spike. So if you can use a ratio framework to reduce the chances of emotional whiplash, you're already ahead of most market participants. And yes, there's a darker reality here too. The moment silver becomes the center of attention, the incentives change. More leverage shows up. More short-term money shows up. More people jump in with zero plan and maximum confidence. And that's when you start seeing violent candles in both directions. So when I trim at a ratio like 50, I'm not calling a crash. I'm acknowledging that the easy part of the trade is done and the hard part begins. Now here's the part I promised I'd reveal because it's the thing that keeps me from overselling too early. There's one scenario that makes me hit pause even if the ratio is flirting with my levels. If the ratio snaps back upward quickly after a sharp compression. In plain English, if we drop through a key level and then rebound hard, that tells me the market may be transitioning into a different phase. In that case, I'd rather wait because whipsaws are where you get chopped up. This is why I keep saying decision tree, not ego. And if you're wondering how to build your own decision tree, here's a simple starting template. Step 1. Pick a level where you start trimming, not selling everything, just trimming. Step 2. Pick a deeper level where you trim again. Step 3. Pick a stretch level where you're mostly done with paper. Step 4. Pick a re-entry level where you'd consider buying again if the ratio widens later. That's it. 4 steps. You can refine it later, but you can't refine what doesn't exist. Now, I want to address something that's going to sound boring, but it's the difference between I made money once and I build wealth. Position sizing. If you were all in on silver, then every tiny move feels like a life or death event. If silver is one part of a broader portfolio, you can be calm. You can follow your framework. You can act like a professional. So if you're feeling addicted to the price, that's not a sign you're bullish. That's a sign your position is too big for your nervous system. And that brings me to another cliffhanger that a lot of people don't like. The market will punish you for being right in the wrong way. You can be right on direction and still lose if you're over-leveraged, oversized, or emotionally sloppy. The market doesn't grade on correctness. It grades on execution. Now let's talk about the rotation piece with more clarity, because some of you hear rotation and think it's code for sell and hide. It's not. Rotation means you're moving from one expression of a macro theme into another expression of the same macro theme. If the theme is currency debasement and hard assets, then silver and gold are both expressions of that. So is a basket of quality miners. So is exposure to other real assets. So is owning productive assets that can pass through inflation. Your job is to decide which expression offers the best mix of upside and survivability at each phase. And yes, this can include cash for short periods if your personal situation demands it. If you need liquidity, you need liquidity. But as a strategy, sell to cash and wait for the perfect crash is how people get stranded while asset prices inflate. Now I'm going to say something that might annoy both the perma-bulls and the perma-bears. I don't need to predict the future to manage this well. I don't need a perfect macro forecast. I don't need to know the exact headline that will move the market next week. I just need a framework that reacts to what the market is actually doing. The ratio is a reaction framework. Now, I promised earlier that I would talk about what I would do after trimming silver without turning it into a shopping list. Here's the way to think about it. If silver outperforms gold and the ratio compresses, then gold often becomes more attractive relative to silver. So one clean rotation is silver into gold when the ratio is stretched. If you're not comfortable doing that, another approach is to keep a core allocation to gold and silver and simply rebalance. Trim the outperformer, add the underperformer. Rebalancing sounds boring, but boring is where wealth hides. Now let's talk about physical silver specifically, because physical is where people get emotional. Physical silver has 2 jobs. Job 1 is financial. Job 2 is psychological. Financially, it's a hard asset that doesn't depend on an app, a broker, or a counterparty. Psychologically, it's the part of your portfolio that lets you sleep when the world feels unstable. So when I say physical gets sold last, what I'm really saying is physical is not there to maximize returns. Physical is there to maximize resilience. And if you treat resilience like a trade, you'll constantly be tempted to sell your seatbelt because you haven't crashed lately. Now, some of you will ask, so are you never selling physical? I'm not saying never. I'm saying last. I'm saying carefully. I'm saying only after the paper side has been managed. And even then, I'd likely keep a core stack because the world rarely gives you a neat ending. Now, I want to do something that script-style viewers love, a quick viewer question, because it helps clarify a common misunderstanding. A viewer asked, if silver is so volatile, Why not just sell it all now and buy back later? And the answer is simple, because later is not guaranteed to be cheaper. People underestimate how hard it is to buy back in after you sell. If price runs higher, you feel stupid. If price dips, you feel like you should wait for lower. And then you miss the re-entry entirely. That's why scaling is so powerful. It gives you participation without forcing you to be perfect. Now, another viewer-style question. What if the ratio goes lower than anyone expects? Then my framework continues to work. I continue to scale out. I don't fight it. I don't argue with it. I use it. And that leads to a final important point. My framework is not there to make me feel smart. It's there to keep me consistent. Consistency beats genius in markets. Because genius is rare, but consistency is available to anyone who's willing to be disciplined. Now, let's get into the part that makes people uncomfortable. What if you're late? If you're watching this and you feel like you missed the move, you have two options. Option 1 is to chase. Option 2 is to learn the framework and wait for the next extreme. Chasing feels productive, but it's often expensive. Frameworks feel slow, but they pay. So if you feel late, don't panic buy because someone on the internet shouted a price target. Build the habit of watching relative value. Build the habit of planning entries and exits. That skill will outlast any one trade. And that's why I keep asking you to share your success stories. Because success stories don't just make people feel good, they teach patience. They show that big outcomes are often built from calm decisions repeated over time. So again, if you've had a win, drop it in the comments. And if you've had a loss or a mistake, share that too. That's how the community gets sharper, not just louder. Now, before we jump back to the closing, I want to remind you one more time to check the description. Bonus links are there, including the premium WhatsApp channel and the channel membership link. And if you want the deeper dive research, members-only videos are there for premium members, with a separate team working to add more detail and more context. All right, now let's tie this together with one final cliffhanger for 2026. The biggest risk is not that silver goes down. The biggest risk is that silver goes sideways while something else becomes the real opportunity, and you miss it because you're emotionally married to your last win. So use silver. Don't become silver. Use the framework. Don't worship the framework. And keep your eyes open, because markets always rotate when the crowd is most confident they won't. And here's the kicker. The next opportunity usually shows up right after you feel the most confident, so don't blink. In the next video, I'll break down what I'm rotating into as this ratio shifts, and what signals would make me speed up or slow down. Now, with all of that said, let's put the plan into a simple, practical sequence so you're not left with theory. If the ratio hovers around my trigger zone and chops sideways, I'm patient. I don't force trades just to feel active. I already trimmed the first portion, and the rest gets handled only if the market earns it. If the ratio compresses deeper, I keep trimming in batches. I'm not trying to prove anything. I'm trying to bank gains while the market is still offering them. If the ratio snaps back up hard after a compression, I slow down. I let the dust settle. Whipsaws are how good plans get ruined by impatience. And if the ratio widens out over time and silver becomes cheap relative to gold again, I'm open to rebuilding. That's the cycle. Now, you might notice something. There's no step in my plan that says, panic. There's no step that says, sell everything because someone on TV yelled. There's no step that says, buy more because a stranger promised $500 silver next month. That's intentional. Because the real enemy isn't the market. The real enemy is you, on a bad day, making a permanent decision based on a temporary emotion. So here's how I protect myself from myself. I write my levels down. I decide my increments in advance. And I accept that I will never capture the exact top. I'm fine with that, because I'm also choosing not to capture the exact bottom of the next pullback with my full position. That's the trade-off I'm willing to make. Now let's be real about physical silver one more time. Physical is not a day trade. Physical has premiums, spreads, and timing issues. Physical is also the part of your portfolio that doesn't need permission to exist. So I treat it with respect. I don't dump it casually. I don't swing it around because I'm bored. And if I ever do sell some physical, it's deliberate, it's later, and it's after paper is fully handled. If you're new and you're trying to build a stack, remember this. A stack without a plan turns into stress. A stack with a plan turns into confidence. And I want confidence for you, not adrenaline. Now, let's add one more reality check. If you're sitting on big gains, you're going to feel pressure from two sides at once. On one side, you'll hear, sell now, it's over. On the other side, you'll hear, never sell, it's going to infinity. Both extremes are designed to hijack your decision-making. Your job is to stay in the middle with a framework and execute in increments. And that's why I keep pushing the GSR. It's not because it's magical. It's because it's stable enough to stop you from being manipulated by noise. Now I want to hear from you, and I'm going to ask this in a way that forces clarity. What is your first trim level on the ratio, and what is your I'm basically done level? 2 numbers. Put them in the comments. And if you're not using the ratio at all, tell me what you are using. Dollar targets, time targets, a gut feeling? No judgment, just honesty. Also, again, if you've had a win, big or small, share it. If you paid off something, if you finally started investing, if you got out of a financial hole, drop it in the comments. People underestimate how motivating that is for others. Now, before we wrap, don't forget the description. Bonus links are there for you, including the premium WhatsApp channel and the channel membership link. And if you want deeper dive content, we do members-only videos with a separate research team built specifically for premium members who want more detail than a public video can hold. And one last creative reminder, if you want to binge silver-related success stories and pick up practical lessons, the link to that other channel is in the description. Subscribe there too, and see what's possible when people stick to a plan. All right, final takeaway. I'm still bullish on the broader hard asset theme. I'm not anti-silver. I'm pro-discipline. I'm pro-rotation. I'm pro-locking wins when the market gives them to you. So I'll keep selling paper silver in steps if the ratio keeps compressing. I'll keep physical as long-term insurance, and I'll stay ready to rebuild a silver position if the ratio stretches back out later. Because the market always gives a second chance, but it only gives it to people who are still liquid, still disciplined, and still paying attention. If this helped, subscribe right now. It takes 1 second. And if you want to support the push against copycats, comment Our John AG so I can see who's really backing this work. I'll see you in the next one.